Ray Dalio, a renowned investor and the founder of Bridgewater Associates, recently gave us an exclusive interview where he delved into the long-term debt cycle and how it impacts the economy. With his vast experience and expertise, Dalio shared his insights on what the economic environment could look like in the upcoming years. In light of this, he warned investors of potential market pain in 2023 and 2024, urging them to be prepared for the possible downturn. Hey, welcome to Stock Market Mate. Today we'll talk about Ray Dalio's thoughts on America's horrific financial crisis. Before we get into it, do like and subscribe to the channel to help us beat the YouTube algorithm. Now if you're done with that, then let's get started. Stocks, according to Dalio, may perform poorly as a group. He believes the cash currently offers a better relative return. Ray Dalio addressed the long-term debt cycle and how it affects us as participants in the economy throughout the discussion. This helps to describe what the economic environment might look like in the coming years. Ray Dalio is one of the most renowned experts to rely on learning about the economic machine. He does an excellent job of simplifying the complexities of the finance world into a few key building blocks and factors that ultimately influence what we see and what happens. The economy is driven by three main principles. It comprises of a productivity trend as well as a short-term and long-term debt cycle. An economy is essentially a collection of various monetary exchanges for goods, services, and financial assets such as stocks that take place between individuals, businesses, and governments. Productivity is the simplest component to understand. Through the accumulation of knowledge, humans become better at manufacturing products and services over time, ultimately raising our living standards. This is referred to as the productivity curve by Ray Dalio. For example, the information we gained while creating automobiles has resulted in significant breakthroughs in supply chain efficiency, resulting in lower costs of goods and services and an overall improvement in our level of living. While output remains the primary source of long-term economic growth, short-term economic volatility are caused by debt. This is due to the fact that acquiring debt allows us to spend more than we generate, but we have to pay it back, therefore we have to spend less than we produce. The short-term debt cycle usually spans 5 to 8 years and involves a surge in debt usage, resulting in high-end spending that can trigger inflation if it surpasses production. The central bank then responds by raising interest rates to curb inflation. As a result, debt financing becomes more costly, leading to reduced spending in other economic sectors. This eventually results in a recession characterized by declining prices. When inflation is not a concern, the central bank lowers interest rates, which initiates the short-term debt cycle again. The cycle has occurred 12.5 times since 1945, with the most recent one starting in 2008 during the global financial crisis. The cycle ended in 2020 due to the pandemic, which caused interest rates to plummet to zero once again. We are currently in the midst of both a short-term and long-term debt cycle, which typically lasts 75 to 100 years. The beginning and end of these long-term debt cycles, which might last decades, can have significant consequences for investors. Furthermore, very few people alive today would have experienced such cycles. Although the quantity of debt may rise and fall in short-term cycles, it tends to grow over time. According to his most recent memo, debt liabilities and assets almost invariably increase throughout the expansion phase of the long-term debt cycle. This was always the case until the debt burden grew unmanageable or the debt assets became intolerably low returning. When large reductions in debt obligations and debt assets occur as a result of a combination of debt restructuring and debt monetization. The simplest method to understand what Dalio means by these long-term cycles is to simply walk through the most recent cycle, which started in 1945 and just ended now. The long-term debt cycle has 4 stages. The first stage began in 1945, when World War II ended and the United States seized control of the economy and geopolitics by establishing itself as the world's most powerful military and economic force. From 1945 to 1971, the US dollar was also backed by and tied to gold. This essentially allows you to exchange dollars for gold. During this period, the United States overspent and borrowed to fund that overspending, resulting in 5 cycles of short-term debt. Over time, some nations with large amounts of US dollars began to trade those dollars for gold, realizing that the US had far more claims to gold than actual gold available, resulting in a bank run in the US. Because the United States lacked sufficient gold to trade for those dollars, they essentially decided to sever the link between the US dollar and gold, which served as the foundation of today's fiat money. The US dollar depreciated significantly between 1971 and 2008. Moreover, there were 5 cycles of short-term debt during this time period, each with an interest rate that ended lower than the one before it, which significantly increased asset values. As a result of the global economic and financial crisis in 2008, interest rates fell to nearly 0%. In order to fuel the economy, the central bank would need to implement a new type of monetary policy. As a result, this stage is known as the long-term debt cycle's final stage, characterized by rapid debt monetization. This took the form of quantitative easing in 2008. To inject money into the economy, the Federal Reserve began purchasing government bonds. This trend continued in 2020, when the government needed more money to pay out stimulus checks, prompting the Federal Reserve to print trillions of dollars and buy government bonds. As expected, this resulted in significant inflation due to increased spending. Moving forward a few years, most of us are probably aware of the situation. Since mid-2022, the Federal Reserve has been raising interest rates to combat inflation. As a result, speculative stocks have declined, and the broader market has performed poorly. So where do we stand today? What does Dalio think about which asset classes will perform well in the future? The market currently believes that interest rates will fall in the long run. Based on the pricing of the bond yield curve, we know that short-term rates have significantly higher yields than long-term rates. However, this contradicts the statement from the Federal Reserve's Jerome Powell, who has assured investors that rates will remain steady in the future, in which Ray Dalio also agrees with. Despite the fact that rates are expected to be relatively high, Dalio believes that the upcoming recession in 2023 may not be as simple as he previously thought. According to him, the real problem with the US economy is its massive debt, which is becoming increasingly difficult to sell on the global market. This puts the Federal Reserve in a difficult position as it attempts to balance two key factors: inflation and debtors' needs. On the other hand, the Fed must keep interest rates high enough to provide real returns that exceed inflation. On the other hand, they must avoid raising rates too high for borrowers who are already in debt and facing rising interest payments, such as businesses and governments. During an interview, Dalio discusses which assets he believes will perform well in the current economic environment. Dalio believes that cash is currently more appealing than stocks for two reasons. The first is that real cash returns have shifted from negative to positive. In 2022, annual inflation was much higher than government bond returns, resulting in a negative real return after inflation. Second, Dalio predicts that the stock market will continue to decline in 2023. Dalio explains in an interview that investments are made based on the expected future cash flow, which is discounted using a specific discount rate. However, changing the discount rate can have an impact on the overall value of the investment, and reverting to the old discount rate is unlikely. This change in the discount rate may have an impact on the economy, affecting prices and other economic factors. As a result, Dalio believes that a combination of rising but stable interest rates and slow and stagnant economic growth will result in lower returns for equity investors from now on. Every investment is a lump sum for future cash flow, and you enter the discount rate, so you've now changed the discount rate. That discount rate will not change significantly, so we're not going back to the old discount rate and prices aren't going back down. Then you start to see an impact on the economy. Again, we believe it's important to take a critical look at how the current economic situation might impact our investment strategies, especially for those of us who are value investors. While macroeconomic predictions by experts like Ray Dalio can be informative, we don't rely too heavily on them. We recognize that equities as a whole may not perform as well as they have in the past, but we still see opportunities for strong returns in specific sectors, industries, or markets. As value investors, our focus is on identifying these opportunities and investing accordingly. It's also worth noting that while Dalio has a solid understanding of the economic machine, his track record on investing in cash has been poor recently. Despite his current recommendation to invest in cash, it's possible that cash may perform worse than equities or even bonds. We believe in taking a long-term view and investing over a 10 to 15-year period or more. In this time frame, there's almost no scenario in which cash will outperform US equities. Well, that's about it for today's video. If you liked our content, or if this helped you, do give us a like and subscribe to the channel. Thank you so much for watching, and we'll see you at the next one.
If you enjoyed this video, you're going to want to watch one of these two videos right here. Enjoy!